Your average venture capital firm sees between 5 and 50,000 pitches a year, and they invest in 0.01 of those companies. So you are seeing big firms get lots of opportunities, get excited about a lot of things, but do very, very few investments. We imagine what that exit would be like, who might buy this company, how that company might IPO. So we imagine and do that as part of our analysis when we're looking at your company. So large number of companies that every venture capital firm looks at, small number that actually get invested. So if you're raising money and you're talking to lots of people, don't be too upset if you have to do 20, 30, 40, 50 pitches, because really what you're trying to do is it's a search problem. You're trying to find the right people who are excited about your market, your business, who have the right amount of capital at the right time, and match it. So that is a search problem. It's not basically just, being the right person at the right time. You're trying to find someone with several different factors to match your several different factors. And so it does require a lot of research and a lot of work. When I was running companies, for one company, I pitched over 400 investors to raise capital. I will tell you that at the time, the brain damage, right, it's real. But like any great athlete, you are getting reps every time you make those pitches. And so I would say there are a lot of people out there who say that fundraising should be easy. I say it shouldn't be. And I say that it's a search problem, so you should be finding the people who best not only want to invest in what you're doing, but who have the right chemistry and who are compatible. So count those meetings as an opportunity for you to find someone who's going to be your next best colleague, a good friend, and a longtime companion, because you will be in business with that person for a decade. Let that sink in. You will work with that person for a decade. So imagine your life when you're 23 or 33 and what it looks like when you're 33 or 43. You go through life events, you transform as a human, you become a different kind of leader. You're going to go through that with that person. So my preamble on all of this is finding an investor isn't finding capital, you are finding a co-parent for your organization, and be just as mindful in isolating that person as you would be in picking someone to have a family with, to keep it real. So that's the preamble. As a CEO, you are always on the search and on the hunt for capital and for capital sources, which means you're talking to people who may not be relevant in this moment for your capital. But here's the thing that investors have. They tend to be smart, they tend to be incredibly well connected, and they also tend to be very curious, and they're always looking for information. And so you can tap into that curiosity as part of your interactions with them. I wouldn't shy away from using investor meetings as a way for not only are you searching and finding someone who could be a good partner and co-parent, but what can you learn from them? So these 30-minute pitches, which are 27 minutes of you talking about yourself, they're not as effective as 30-minute pitches where it's an equal conversation between you and another very smart person who is interested in what you're building. And so leverage that time, which means that how to fundraise starts with not only knowing a lot about your business and what's attractive to an investor, but understanding who's investing in your companies like yours, at this stage, at this time, to the extent that you need. And so being prepared for those meetings, showing up on time, asking great questions. I know when I was running companies and now as a VC, I would always send my materials beforehand because I wanted to increase the probability, increase the chances of having a great dialogue with someone who was just very smart, because that's really where that bonding comes from. Because the investor getting pitched by you might fall in love with the idea, but they're also asking themselves, can I work with you for 5 to 10 years? And so it's important when you're thinking about pitching to think about compatibility, do your research, do your analysis, figure things out ahead of time, ask questions that are actually buying questions for you and for your company. And then at the end of all those conversations, there's no harm or no shame in saying, does my company look like one that you might invest in? A lot of us are very shy. I know as a woman, the idea of pursuing is a unique new facet of your skill set, right? And in our society, the feminine is pursued. And so pursuing means that you are also trying to get to some level of clarity and closure at the end of each interaction. And so I would not feel shy about that, obviously doing it in a very respectful way. And as you get indication, it's important to be honest about that indication. Some VCs will say, we'll look at it, but might not be something that we're going to pursue. That's a really great signal. It's a negative signal. Or, wow, I really like what you're up to. I want to talk to some of my partners who might be experts in this space, and I will get back to you. Great buying signal. Or, tell me more about how you envision this round coming together, or how you think we might fit. Another positive signal. A negative signal would be, I don't like it. And so we love those because a fast no is better than a slow maybe in this business. And so knowing that you're getting these negative buying signals is really important to be clear about and to also accept, because there are a lot of capital investors out there that you can approach about your business. A term sheet is typically a document that has a lot of terms. They're a couple pages long, and it kind of frames what that fundraising is going to be like. It is not necessarily legally binding. It is a structure, a framework, a blueprint for how you're going to work together and what that financing is going to look like. And so a lot of founders who don't like fundraising will take that and will say, okay, great, when are we going to close? But in reality, and the word that I'm going to write down here is how to create a market around your financing. This is really, really important. And creating a market around your opportunity does a lot of things. I've heard it framed really well, and I love this. It's getting other people to grade your homework. It's getting other people to say, wow, this company is worth that, or I don't know if I would give you that kind of valuation, or I like this part of your business, but have you thought about this? VCs are more apt to accelerate a conversation with you if you have a pending event, which is a term sheet. And so creating a market really is going to other people, and I would always encourage you not to share the actual term sheet because it is under non-disclosure, but you can talk about those terms, and you can talk to people about those terms. So having good relationships with investors is a great thing, because you can say, hey, I just got a term sheet, it had these terms, what are your thoughts? And you're asking that both to get feedback and to possibly get competitive information that you can use to increase the value of that term sheet, or to get different ones, or in some cases to get people who will be part of that investment. Now, at the early stages, you're often just working with the lead investor and maybe people on their team who are gathering information. As you move into the A's, the B's, and especially the C's and the growth stage investments, you're going to something called a partner meeting. Pitching an investor, is getting them excited about your idea. You've seen Shark Tank, you've seen 30-second pitches, you're getting the spark ignited, right? That's what you're doing, you're starting the fire. Now, for larger checks, I remember I was raising a Series C when I was CEO, and we were raising $14 million in equity and about $7 million in debt. And we were moving down the line with this one venture capital firm. We had this one partner, we really good vibes. They were not the founding partner or the managing partner, but we had great connection. They understood our category, and we were moving along. We talked price, we talked other things, and they said, great, come to our partner meeting, and then we'll, if our partners feel good about it, then we'll move to a term sheet. I'm gonna let you in on a little secret. When you get a lot of people together, there are politics. And in partnerships inside a venture firm, there are politics. There are also differing opinions. And so a pitch is not what you're doing in a partner meeting. So if you get to that place where you're about to move into a partner meeting, really what you're trying to sense is you're trying to understand what the dynamics are of your partner and his or her other partners, the probability that they will listen to this person can gain consensus and move your deal through, and objections. It is not a sales meeting. It is a fact-finding mission, and it is a myth-busting mission. That's what a partner meeting is. What I would say is that look at fundraising as a place to be curious. Look at it as a search problem. Be clear about what you need and want, and find people who match. And also be very humble, because what you're going into is a relationship where people will hold you, your team, and your reputation accountable for the decisions that you make and the outcomes that you create. My advice for founders is obviously be very careful with who you bring around the table. But secondly, if you're having an issue, really look inward to see how you're managing. And I would ask them, hey, are there things I could do better in this relationship with you? Are there things that I can bring to the table that would make you being a value-added partner easier, better, more bountiful, right? And then lastly, if it doesn't work, something has to change. And there are lots of ways to solve that. You can either structure the relationship differently. You can ask them to put another partner, another principal, or someone from the firm. These are great proactive steps. Or you can potentially have them exit at a secondary. Like there are ways. My strong advice is not to let it stack and fester, because it can't help but seep into the other board members, your management team, the industry. So if it's not working, got to be proactive. Is it you or is it them? And if it's y'all, Texas, then you got to be proactive. You want to talk to other people about it in a very mature way, because sometimes it doesn't work. It's okay. And if you need to exit that person, do so in a way that protects the relationship, the reputation, and their capital. Because if you don't, other board members will feel it, see it. It'll become part of the dynamics now of your board, which will not be productive. It'll also affect your management team, because now you're in a dynamic where there is stress, resistance, chaos. And that affects not only how you manage your team and your energy, but also potential future rounds. Because what if they tell everyone, you know what, I'm not investing in this company anymore? And that becomes a signal that the market hears. And so that's important to be mindful of.